The last street opens in the red following weak cues from Wall Street as concerns around the US economy's health were reignited. The Nifty slips below 25,100 intraday, led by IT and financials. Mid-caps relatively outperform.
IT stocks declined on the back of a sell-off in tech stocks on Wall Street. Nifty IT is also the top sectoral loser, with all the constituents trading in the red.
GIC's RE slides more than 4%, with the government set to sell up to 6.8% stake via an offer for sale priced at 395 rupees a share.
Oil marketing companies gain as crude slips 5% overnight to a 9-month low. Paint stocks as well rally and trade.
And mobility services provider eCost Mobility sees a steady debut on the exchanges. The stock lists at 390 rupees a share, which is an 18% premium, and now surges after its listing.
Hello and welcome to Chartbusters. I'm Nigel D'Souza, and joining me is Hormuz Patakia. Hey Hormuz, we're in the red, but it's not as bad as what the global setup is. So the Nifty is down, roughly around, I think, 150 points or thereabouts. The Nifty Bank went to that crucial low of around 51,250, and we bounced off that mark. And the breadth of the market isn't that bad. When you wake up to, the global indices being down 1 to 2%, and you're down 150 points in the Nifty, I think it's par for the course.
You would take that any day, right? After, especially coming on the back of a 14-day move that the
Indeed.
Nifty has had, you needed a reason to sell, and there was possibly a reason like that what happened on Wall Street overnight. But yes, the Nifty is holding on to that mark of 25,100 on the downside, and it's the weekly expiry of the Nifty Bank today, so that is going to be the index to watch out for. It's been the index to watch out for all through this week. The 51,250 level, as Nigel was mentioning, it bounced off those levels, now almost 80 points off the lows of the day. So the Nifty Bank is the one to watch out for in today's session. What's leading the losses on the downside? Of course, it's IT. No surprises there after the sell-off that we witnessed in the Nasdaq overnight. The Nifty IT index down 1.5% in today's session, and that should be par for the course, I guess, as well, because the IT index has also seen a very significant up move over the last few trading sessions as well.
Indeed, and the paint stocks that we pointed out earlier today, well, they are the ones that are doing well. Big underperformers, paint companies, Asian Paints, Berger Paints. In the last 1 year, if you bought these companies, you made no money at all. But in today's trading session, they are doing fairly well. And the reason is that crude oil prices are lower. Valuations, well, they are more or less flattish, or in fact, it's contracted a little bit. And price hikes have come about. So that's why, in fact, you have paint companies that are doing pretty well. But let's get in. Soni Patnaik of JM Financial Services, who joins us for a technical check. Hi, Soni. Good morning. 14-session winning streak. You'd like to see the 15th one, but it appears it's going to be a challenge. What are you doing? Do you believe you're in for a bigger correction, or would you be looking to buy the dip?
Good morning, Nigel and Hormuz. Thank you for having me on the show. So I think Nifty, there was a target for Nifty to test 25,350 odd levels in September series. It has already done that. It was in most of an overbought zone. So now the correction, the cool off that can be seen today is actually helping Nifty to cool off from those overbought zones. It is very crucial for Nifty to hold on to a base of 25,000, which is a crucial base for the September series. Only if this base breaks on closing basis, we can see Nifty heading towards 24,800, 24,700. It can be in the later stage of the September series. So this is the range for now. 25,000 is a strong support. If it holds, we can see it bouncing towards 25,200 at max. Looking at the option chain today, there's very aggressive writing happening on the call side at 25,200, 25,300 strike options. So maybe that acts as a resistance, and it may not let Nifty to cross those barriers for the day. If we talk about Bank Nifty, 51,500, 51,700 continues to act as a very strong resistance. And Bank Nifty is trading in a very small range. So 51,000 is a support. Only if it breaks 51,000, Bank Nifty will also break that crucial support. It can head towards 5,500, 5,400. So from both the indices point of view, it is better to remain a bit cautious. Any rise that can be seen could be used as a sell on rise. The pressure may continue. And only upon a break of the important support levels for both the indices can see a further correction, maybe in the second half of September series.
25,000 is a very important level, as Soni was highlighting. Soni, good morning. Thank you for joining in. Couple that up with your stock-specific recommendations as well. Are there any stocks that you're recommending on the buy side in a market like this?
Definitely, Hormaz. I think I'll go with a balanced approach, a buy and a sell. The buy comes in for Hindustan Aeronautics HAL today, which is seen sustaining above 10 and 20 EMA. So one can buy it around 49.20 odd levels if it crosses, and on any declines up to 4900. That range can be seen to buy in futures, keeping a stop loss of 48.30. A target of 5,000 can be seen on a positional play for HAL. The second would be a sell call. It's in Polycab futures. One can see a sell. It's an official recommendation for the day today. One can sell Polycab futures around 6,700 if it breaks, for a target of 6,600, keeping a stop loss of 68.50. So Polycab futures is breaking 20 EMA support. There'll be an option chain breakdown even if it goes below 6,700. So that becomes a good conditional sell for the futures. Below 6,700, it can slide towards 6,600. So that's a balanced approach for the day.
What about oil marketing companies then, Sony? The crude prices have given up all their gains for 2024. Which among the three look the best to you, or do you wish to wait it out a little more?
I think it's better just to wait it out for a bit because the markets can be a bit volatile. However, the entire space, sector has been broadly overperforming. I think we've seen a very sharp sell-off in ONGC today. It has approached its crucial support of around 305, 303. Only if it's able to hold on to the support, there can be a small bounce back towards 320, but not a lot of confirmation buying coming in. So it's better to wait out for the entire sector.
All right, Sony, we leave it at that. Thank you so much for joining in with your views on the index as well as specific stocks as well. That was Sony Patnaik of JM Financial. Shifting focus to our special segment where we get you a few ideas for profit from Money Control Pro. Anubhav Sahu today joins in to talk about a stock that he's tracking very closely.
Our conviction of chemical sector continues to improve. While macro data emerging from China is mixed, there are indicators which point out that domestic demand in China is bottoming out, and this can lower the export intensity from China. Now this, along with series of anti-dumping measures by India, should bring relief to chemical sector in India, which has been facing pricing pressure. Now at the same time, it is noteworthy that Indian chemical sector has by and large been able to push through sales volumes in recent times. One such strong play on the import substitution side is Bajaj Mines. The medium-term growth driver for the company is a series of projects which are getting commissioned in the near term. Now, this include methylamine capacity, which will nearly double by December of 24. Now, management expects a minimum 10 to 15% volume growth in fiscal 25. It also expects the utilization level of some of the newer projects to rise to the range of 50 to 60% in fiscal 26. Which in turn would bring in operating leverage. Additionally, implementation of solar power projects should also help in lowering operating expenses. The current valuation, in our opinion, is not demanding, and hence investors can accumulate it at the current level.
Ideas for profit coming in there from Money Control Pro. Time for a short break. More on the markets and specific stocks on the other side. Stay tuned. We'll be right back.
Welcome back. Well, keep an eye on a couple of stocks from the broader markets. You have India Mart, that's bucking the trend. It's moved to the high point of the day. So good up move is what we're seeing on that one. And Godrej Properties, it's managing to defend this 2,850 odd mark. It's not able to get past the 3,000 mark. I think that's going to be the crucial point that it needs to break on the upside. But for the time being, it's defending that crucial level on the downside. So that stock as well is doing well. On the flip side, Godfrey Phillips actually is selling off. The stock is down 4.5% as we speak. And Manappuram Finance, that was showing some promise, suddenly that one as well has come in for some selling pressure. Well, let's focus on Raymond Group then. Raymond Lifestyle shares will be listed on the bourses on September 5th after the demerger from the parent company. Earlier, we caught up with Raymond Lifestyle CEO Sunil Kataria and asked him about the listing and how they see growth going ahead this wedding season. Let's listen in to what he had to tell us.
wedding linked spend, which did not happen in the first quarter and maybe the first half of the year, would start coming back very, very strongly from October onwards. So we expect a very strong double-digit growth happening in the second half. That is something that we're very clearly seeing happening. And if I were to see from a business point of view, over a long period of mid-range to around, next 3 years guidance that we have to give, we have built in very, very strong pillars of the business. And each vertical has got very strong pillars built in terms of its growth, which we have been talking about in various meetings. We clearly see ourselves being able to deliver a very strong, healthy, 12 to 15% consistent growth rate over the next 3 to 4 years. One piece we are really gunning for and pretty confident is that over the next 4 years, we would like to double our EBITDAs from where they are currently. In the branded apparel business, if we talk, we are gunning for a very, very high double-digit business growth there, which will give us, which is led a lot by store expansion. So we are looking at opening up another, around 500 odd stores over the next 3 to 4 years in our branded apparel business alone. And this is, without the ethnics business. If I were to take all these businesses together, we are talking of around 800 odd stores getting added, including ethnics.
Raymond Lifestyle, their royal eyes on the listing of this demerged entity from Raymond. Now, moving on to some primary market action, then Bajaj Housing Finance's 6560 crore IPO will open on the 9th of September for subscription. The issue will consist of a 3,000 crore rupee offer for sale and a fresh issue of 3560 crore rupees. Rima caught up with the management of the company and asked them about the regulatory requirements from the company and its growth prospects going ahead. Listen into a slice of that conversation.
Clearly, the RBI requirement, given our size and being in the upper layer, was to list before September 2025. But what's equally important is that while Bajaj Housing Finance is only a 7-year-old company, as you mentioned, assets as of 31st March 24 at 91,000 crore, the fastest growing housing finance company, the largest non-deposit taking housing finance company. So it becomes important to diversify our sources of borrowing as well. Our capital has all come from the parent, that is Bajaj Finance, the last 7 years. So it's a combination of size and the RBI requirement, both I would say. But we think for the next couple of years, this should suffice. And as you know, we have the requirement to dilute 25% over the next 3 years. And depending on how growth is going in the coming years, we'll take that call between primary and OFS.
If you look at a housing market itself, let us say home loan market, which is the largest part of a mortgage market, the market by plus some estimates plus minus was 30 lakh crore plus as of EGM in the country. Loan against property 10 lakh crore plus. So the kind of a market size which is there, compared to that, our size, relative size of a 91,000, 97,000 crore as of a 30 June still remains small. So we have an opportunity to grow, but we are not guided by a particular number. Subject to opportunity, market opportunity, and our ability to take space to the extent what we can take. Happy to get the outcome. More important and relevant part is, the market being very large is one part. This is also growing at various estimates on the industry at a 13 to 14% kind of a CAGR, which is a very high pace of a growth.
Interesting one. Well, let's move on then. The GST Council meet, which is scheduled to take place next week, will take up a whole host of issues. Sources tell us that a potential relief is in store for Infosys and tech giants like Amazon, Google and Meta. Timsy's been on top of that. She's joining us to give us a sneak peek into what we can expect. Timsy?
Well, the 54th GST Council is likely to meet on 9th of September in New Delhi, keeping a table full of agenda items. According to sources, the Council is likely to deliberate on extending a relief to Infosys. The IT major, remember, was issued a pre-show cause notice worth 32,000 crore rupees, out of which 2,000 crore rupees worth of liability was waived off by DGGI for FY18 based on clarifications shared by the company. But for the remaining liability, the company has sought time from the tax authorities, and in the meantime, it is understood from sources that they could get some relief from the Council. Apart from this, Council is likely to get in relief for data hosting players such as Amazon, Google, Meta, etc. It is likely that the Council could consider clarifying on treatment of place of supply, what should be treated as export of services, GST rate treatment when recipient is abroad, and much more. Sources also share that the Council is likely to reject the proposal pushed by the EV industry to consider a GST exemption on EV charging at public charging stations. Council is likely to to propose that 18% GST on charging should continue. The industry had also pitched for a reduction on GST on manufacturing of Li-ion cells for Li-ion batteries for EV, battery packs, electric motor EV drive assembly, etc. from 18% to 5%. Here we learn from sources that the council-nominated fitment committee is understood to have recommended against the demand, saying that any reduction here could lead to inversion of duties. Not just this, the council could also get in relief for the education institutes and universities such as IIT Delhi on grants and donations received for research. Council could exempt them from GST. Remember, recently DGGI had issued 7 show-cause notices to universities and institutes, including IIT Delhi, seeking 220 crore rupees worth of dues. And last but not the least, the council is likely to hold a review of the 28% GST levied on online gaming, casinos and racecourses. The council will take up a status update here, and what we pick up from sources is that there could be a setback for this particular sector too, as the sector had sought clarity on the past demands from 2017 till 2023 from the council, and the fitment committee is likely to have deferred the matter, seeking more information and data. Remember here, the past liabilities of over 1 lakh crore rupees. Let's see what all happens when the council meets.
All eyes on the GST Council meeting. Timsy, thanks a lot for that. Time for a short break. On the other hand, we get you excerpts from an exclusive conversation with Ashok Leyland. Stay tuned. Back on the other side.
Commercial vehicle manufacturer Ashok Leyland believes that the second half of the fiscal could provide some much-needed relief to falling M and HV sales in July as well as August. Speaking exclusively to CNBC-TV18 Jude Sanet at the launch of the company's Uptime Solution Center for its connected BS6 vehicles, Leyland's head of MHCV said that 2 months of rains have kept sentiment a little bit muted, and that the decline for July as well as August was along expected lines. Let's listen in to a slice of that conversation.
Whenever we sell a new vehicle, we sell these vehicles with 1 year subscription. So all those vehicles which have been sold in last 1 year, they are up and running with as a connected vehicle. Of course, beyond 1 year, customers have an option to renew this iAlert subscription, and we have observed that now customers are really finding value in this iAlert what we provide, and then almost 20% customers are opting for renewal of their subscription. So that is it's not 20% of entire population, it is 20% of renewals, and beyond this, whatever vehicles we have sold in last 1 year, they have this connectivity.
Right. So what becomes of your future launches? I know that we're talking about an electric era, alternative fuels are also something that's being discussed an awful lot. Will all of the fleet going out of Ashok Leyland stables now be equipped with connected features, which will then by default bring them on an Uptime Solutions platform?
Yes, absolutely. Any vehicle which goes out of Ashok Leyland fleet will have this iAlert, and all of these vehicles will be connected vehicles.
Right.
And definitely it is helping us also to kind of get the data from these vehicles, work on this, find how can we improve the performance of the vehicle. So it's really helping Ashok Leyland also.
Mm-hmm. And no doubt that's the feature of connected vehicles, AI, and the entire mechanism of the Uptime Solution Center. Shifting focus just a bit, you're seeing the months of July and August not bode too well for the MHCV sector. You're seeing degrowth across the board. As far as Ashok Leyland is also concerned, degrowth in sales and MHCV sales. Now, considering the fact that there was a lot of optimism that this fiscal would lead to bigger projects, better projects, and growth for the sector, what do you ascribe the slowdown in the last couple of months to?
So we are not worried, first of all, because if you see traditionally, July and August have been months of rains, and this last 2 months have seen severe rains across India. Many states are kind of in submerged condition also. So we feel it's a temporary phenomena, and there's nothing to worry about this dip in the TIV. Mm-hmm. And we are in touch with our customers, and they are confident. Only thing is, in the beginning also, we felt that probably Q1 or Q2 will be subdued, but market will pick up from the H2, and keeping finger crossed.
Mm-hmm. Do you also see a possibility that projects that were envisaged or proposed or planned for haven't quite kicked off on the ground, and that could also be perhaps one of the reasons why you're seeing a slowdown?
Right now, when we are talking to customers, yes, we are getting a sense that slowly things are coming into shape. I think it's only a matter of time.
Okay, so inflection point, when do you think it could happen? It is a matter of time, no doubt.
It's a matter of time, but I think H2 should be good for CV industry.
Ashok Leyland there in an exclusive conversation with CNBC-TV18's Jude Sanith. Time to call a wrap on this edition of Chartbusters. From Nigel, me and the team that put this show together. Thank you so much for watching. Trading Hour up next.